In the last video, we had seen that costs can be classified on the basis of six parameters, that is nature, function, behavior, controllability, normality, and cost for managerial decision making. We had discussed in details the classification of costs on the basis of nature, function, and behavior. Today, we are going to see the classification of costs on the basis of other three criteria, that is controllability, normality, and cost for managerial decision making. On the basis of controllability, the costs can be divided into controllable cost and non-controllable costs. Now suppose for making 1 unit of a product A, we need 8 man hours. So for 10 units, we will need 80 man hours. Now the employees can be motivated to increase the efficiency such that 10 units can be completed in say only 70 hours. With experience and proper motivation, incentives, etc., employees do tend to reduce the number of man hours required for the production of any product. So, management can control this kind of a cost by way of proper incentives and motivation to its employees. Suppose raw material. During a process, say for making 1 unit of product A, we need 10 kgs of raw material. Now we need 10 kg because in the normal production process, say around 1 kg of the material will be lost on account of spillage, pilferage, etc. So if we put in an efficient production process, then we can reduce the amount of spillage, pilferage, etc. such that say only 9.5 kgs of the raw material will be required. So, by way of efficient production planning, the amount of raw material used can be reduced by avoiding spillage, pilferage, etc. So, direct labor, direct material, etc. are controllable costs. That is, it can be controlled by the management by establishing efficient processes. Now, suppose one entity has 5 divisions A, B, C, D, and E. The manager of Division A has control over the direct labor, direct material, and such other costs. The manager of production of Division B will have control over his own divisional costs, and so will the manager of C, D, and E. But say there is an accounts department which looks at the financial aspects of all these 5 divisions. Now, this department is centrally managed to look after all the divisions. So, during the year, say 1 lakh is the total cost of the accounts department. So, this cost will be apportioned between the divisions, say equally. So, 20,000 will be apportioned to each of the division. Now, the manager of Division A will have control over its direct labor, direct material, etc., and it can affect the costs by way of establishing efficient processes. But the amount of the accounts department, which is centrally managed, that is apportioned to Division A, will not be under the control of his manager. He will have to bear this cost of 20,000. So, for Division A, the accounts department cost is an uncontrollable cost because the manager of Division A cannot influence the amount apportioned to it. So, if the manager is able to influence the costs, then it is called controllable cost. If the amount is not under the influence of the member or the manager of the division, then it is called a non-controllable costs. So controllable cost is a cost that can be controlled slash influenced by a cost, profit, or investment center manager. Example, direct costs. Uncontrollable costs are the costs which cannot be influenced by the actions of a specified member of an undertaking. Example, the costs apportioned, central costs apportioned to a division cannot be influenced by the division manager. So we see that in actual, there is no cost that is uncontrollable. The accounts department cost might not be under the control of the manager of division A, but it can definitely be controlled at a central level. The central department, the accounts department, can control his or her own cost. Therefore, it is only in relation to a particular person that we may specify a particular cost to be either controllable or uncontrollable. The direct material cost is under the control of the manager of Division A, but it will not be under the control of the manager of accounts department. Similarly, the accounting costs is under the control of the accounts department manager, but will not be under the control of the manager of division A, B, C, D, or E. Next, we look at the portion of cost, the classification of cost on the basis of normality. Now, suppose we are making a product, say product A, for which we require a raw material, say X. Now, this raw material X will have to pass through Say two machines, machine A, machine 1, then to machine 2. Finally, the finished product A will be made. Now, when the product X passes through machine 1 and then through machine 2, say if we have put in 10 kg of material X in machine 1, then some of the raw material will stick to the machine. While pouring the material into the machine, there might be some pilferage, some material might get spoiled, they stick to the vessel, etc., because of which the output of machine 1 might contain, say, only 9.8 kg of material X. Now, when this quantity is again poured into machine 2, there might be some more wastage because of pilferage, spoilage, etc., because of which the final product may have, say, only 9.5 kg of raw material X. Now, this cost, this so in this whole process, we have lost zero point 0.5 kg of material X. This cost is a normal loss. That is, on account of pilferage and all, in every production run, this much quantity will be lost no matter how efficient the process might be. You may reduce it to a insignificantly low amount, but there will be some sort of a loss because of manual interventions on account of pilferage, spoilage, etc. So this is a normal cost. This cost is normally incurred at a given level of output and it cannot be avoided completely. But that there's a suppose there's a hole in the machine 1 which the production manager has not yet seen. So when we pour 10 kgs of the raw material into machine 1, from this hole, say 2 kg of raw material flows out. That is, it does not form part of the production process. This is like a one-off instance. Normally, 2 kgs will not be lost in the production process. So, this is an abnormal loss. Suppose there is an issue in the functioning of machine 1, because of which the 10 kg of raw material could not be converted into the finished product due to certain defects. So that entire 10 kg of raw material will be a cost to the company. We cannot sell it in the market. But this is not a normal occurrence. It is a one-off instance due to certain defects in the machinery. So that is an abnormal cost. So we see that normal cost is a cost which is generally incurred at a given level of output due to reasons such as pilferage, spoilage, etc. And it cannot be completely avoided because there is manual intervention in the production process. And even if there is no manual intervention, some raw material will be lost in the production process. And abnormal costs are those costs which are normally not incurred at a given level of output. These occur due to certain defects in the machinery or certain manual errors. These are mostly one-off instances. So, on the basis of normality, costs can be divided into normal cost and abnormal costs. Normal cost is a cost which is normally incurred at a given level of output under the conditions in which that level of output is normally attained. Abnormal cost is the cost which is not normally incurred at a given level of output in the conditions in which that level of output is normally attained. Now we are going to look at the classification of costs for managerial decision making. One of the objectives of cost accounting is to help the management in decision making. So, to enable the management in making correct decisions, the costs are defined into various categories, each of which serves a different purpose in helping the management. The first is a predetermined cost. When we start a production process, we make an estimate, say, for producing 1 kg of finished goods, we will need 10 kg of raw material X. Sorry, for making 100 kgs of a finished goods, we'll need 100 kg of raw material X. We'll need 50 man hours. 1 kg of raw material costs, say, 10 rupees. So 100 kg will cost 1000 rupees, and 1 labor hour costs, say, rupees 20. So 50 labor hours will cost you 1000 rupees, and other direct expenses of, say, 2000 rupees. So we have determined that on a total of 4000 rupees will be incurred for making the finished goods. This is an estimate. This is determined at the beginning of a production process so that the costs which is actually incurred can be measured against it, and decisions can be made by analyzing why there is a difference between this estimated cost and the actual cost. So a predetermined cost is a cost which is computed in advance before the production starts on the basis of specification of all the factors affecting the cost. Cost which is computed in advance. It is important to note that the production has not yet started, so we don't know what the actual cost will turn out to be. This is just an estimate basis the experience of the management and the recipe of the product. Before the production process, process starts on the basis of specification of all the factors affecting cost. Now, this predetermined cost, which is calculated from the management's expected standard of efficient operation, this is known as a standard cost. Means we have, first of all, it is predetermined because it is computed in advance before the process starts. Now, this total cost of 4,000 rupees has been determined by the management on the basis of his or her expectations of what the cost will be in case of an efficient production process. So this is known as a standard cost. How much cost should be incurred if the production process goes as per the plan? So the next is a standard cost. That is, it is a predetermined cost because we have estimated this before the production process starts, which is calculated from management's expected standard of efficient operation. So this is based on the management's expectations of how much cost will be incurred if the production process goes as per the plan and the relevant necessary expenditure. This is often used as a basis for price fixation and cost control through variance analysis. Suppose the standard cost expected was 4,000 rupees and in actual the cost incurred is 4,500, then management identifies the reasons for that increase in the cost of 500 rupees, where the process has gone wrong because of which that additional cost was incurred. So this helps the management in controlling his costs. Next we have explicit and implicit costs. Now suppose for your business the management will have to pay say rent of rupees 1 lakh rupees, salaries of 5 lakh, other expenses of say 10 lakhs. All these are requiring a cash payment. That is, you have to pay cash in all these cases. Suppose management has 10 lakh rupees with it. Now with this 10 lakh, They can either keep it in a savings account and earn an interest of 10,000 rupees per annum, or he can invest in a new opportunity, say in a new product or technology which will help the firm grow in the future. Or they can invest it in, say, equity or mutual funds and earn an income of, say, 15,000 rupees. So, with this 10 lakh idle cash, any of these opportunities can be availed by the company. But they can only do one of these three things. That is, either the firm can keep it in a savings account and 10,000 earn 10,000, or invest it in a new technology which will yield results in the future, or they can invest it in equity or mutual funds and earn an income of 15,000 rupees. If the firm invests it in savings account, then they will have to forego this 15,000 rupees income on equity and the future inflows that might have occurred had the firm invested in a new technology. If the firm invests it in a new technology, then they will not be able to earn the savings account interest now or the mutual fund income of 15,000 rupees. So these are implicit costs. They do not involve any immediate cash payment. If you had opted for this option, that is, invest in a new product, you would have foregone the savings account interest of 10,000 and equity investment of 15,000 rupees. But these are not actually involving a cash outflow. We will not record this invest amount foregone in our books of accounts. So this is known as an implicit cost. So explicit cost and implicit cost. Explicit costs refer to costs involving immediate payment of cash, implicit costs do not involve immediate payment of cash. Explicit costs are recorded in the books of accounts. Implicit costs are not recorded. Explicit costs are also known as out of pocket expenses. Implicit costs are also known as economic cost. Explicit cost examples: salaries, wages, etc. Suppose management is having a project going on. So, this project had started 1 year back, and till now, the following costs have been incurred. Say, material cost 1 lakh rupees, labor cost 2 lakh, and other miscellaneous expenses of, say, 5 lakhs. So, a total of 8 lakh has already been incurred on this project. Now, this firm is facing some financial issues. So, they have two options with respect to this project. They can either continue the project on its own or sublet the project, that is, assign it to another firm for a particular cost. When the project is finished by the other firm, it will be transferred to this firm. If the firm decides to continue the project, it will incur an additional cost of 10 lakh rupees. If it delegates it to another firm, the costs will be 11 lakh rupees. So now the firm has to choose between these two options. So if we see that the expenses that will be incurred in the future will be considered by the firm in deciding which option to choose. This 8 lakh has already been incurred and the company can do nothing about this. But they can control the future cost. That is, if they sublet the project, they will have to incur 1 lakh rupees extra. Whereas if they continue the project, only 10 lakh rupees additional will have to be incurred. So, this 8 lakh, which has already been incurred, will not affect the decision of the firm in choosing the option. The future costs that will be incurred will affect management's decision. So the past cost of 8 lakh rupees is known as sunk cost. So sunk cost is a historical cost incurred in the past. They play no role in decision making because it has already been incurred and the management can do nothing about it. Suppose we know that for making 10 kgs of a finished product, material cost is 10 lakh, labor cost is 5 lakhs. So 15 lakh total. If you make 20 kgs, then it will be 30 lakh and so on. So the material cost can be directly linked with the output. More the output, more will be the material cost. But now suppose during the production process, the management decides to give training to its employees. This training will incur a cost of say 50,000 rupees. If you produce 10 kgs of finished product, then also this training cost will be 50,000 rupees. If you make 20 kgs, then also it will be a 50,000 rupees. This is not a expense which can be directly linked with your finished product. This is a decision of management, a one-off decision to give training to his employees. So this is known as a discretionary cost. This is not tied to a clear cause and effect relationship between the input and the output, such that material cost and labor cost can be linked. More will be the finished products, more will be the material cost and the labor cost. But training to employees is a decision of management. Again, say management decides to give an advertisement in the newspaper for its product. This advertisement will incur a cost of 10,000 rupees. Now it is not directly linked to your finished product. It is a decision of management. So these are known as discretionary costs. These are not direct costs and they arise from periodic decisions regarding the maximum outlay to be incurred. So they are not tied to a clear cause and effect relation between inputs and outputs. They usually arise from periodic decision regarding the maximum outlay to be incurred. Examples are training to employees, advertisement expenses, etc. Now, material costs, all the direct costs such as material and labor costs are assigned to a product. If we have product A, B, and C, we'll say that the material cost of product A is 50,000, product B 70,000, product C 1 lakh rupees, labor cost product A 1 lakh, product B 1 lakh 20,000, product C say 2 lakhs, and so on and so forth. So all the direct costs are directly assigned to the products, but overhead administrative expenses such as say selling and distribution expenses, expenses of the HR function or accounts department are not assigned to individual products. Say the total revenue for all these three products is 1 lakh rupees, then these expenses are directly charged against the total income. Say selling and distribution expense 10,000, HR functions 20,000, and accounts department 10,000. So we'll say that total 1 lakh was a profit from all these three products, and we subtract all the non-manufacturing expenses, administrative functions from the profits of the individual product and arrive at the total profit of 60,000 in this case. So these are known as period costs. So period costs are those costs which are not assigned to the products but are charged as expenses against the revenue of the period in which they are incurred. Not assigned to the products but are charged as expenses against the revenue of the period in which they are incurred. Examples are selling and distribution expenses, expenses incurred for the accounts department, etc. Over here, we had seen discretionary costs, which are not directly tied to a particular product, such as training, advertisement, etc. So, the expenses which can be directly linked with the finished product, such as material cost, labor cost, etc., these are known as engineered costs. So, engineered cost are the costs that result specifically from a clear cause and effect relationship between the inputs and the output, such as direct costs, direct material cost, direct labor cost, etc. So far, we have seen the following costs for managerial decision making: predetermined cost, standard cost, explicit cost, implicit cost, sunk cost, engineered cost, discretionary cost, period cost. The explicit cost is also known as out of pocket costs. Now we'll see what is a shutdown cost. Suppose temporarily the production process is not going on. Now, since you're not producing the finished product, you will not be incurring the direct material cost, labor cost, etc. But even then, you will have to pay the rent of your office building, insurance for your plant and machinery, etc. So these are known as shutdown costs. So those costs which continue to be incurred even when a plant is temporarily shut down, such as rent of the premises, depreciation of the machinery, etc., are known as shutdown costs. These are fixed costs which cannot be avoided during the temporary closure of a plant. So, shutdown costs are costs which continue to be incurred even when a plant is temporarily shut down, such as rent, depreciation, etc. In other words, it is all fixed costs which cannot be avoided during the temporary closure of a plant. So, with this, we come to an end of the classification of costs. Hope these concepts are clear to you. In case you have a doubt, you can post them in the comment section below. If you like the video, do share and subscribe. Thank you.